stewarding and climate risk. Throughout her body of work, Madison has probed the ways that data and projections about the real world are transformed into the metrics used by investors, insurers, and regulators, and the ways that that process can misfire. Most recently, she's written about the business of physical risk, calling for better publicly funded natural hazard modeling. Ben is a political economist who has been at the forefront of recent research on asset manager capitalism, which Ben has analyzed as a new, historically distinct era in which asset management firms like BlackRock, rather than pension funds or banks, wield shareholder power over the rest of the economy. Ben's research bridges macro-level shifts in how corporate governance works and a close attention to the structure of the international financial system. Most recently, Ben and two co-authors have published a paper on the distortionary impact of multinational corporations on economic statistics, shedding light on the growing gap between national income accounting and the real economy. As for me, I run the Center for Active Stewardship, which is a project that we launched about 9 months ago, focused on the relationship between the financial system, and especially the asset management industry, and the corporate response to climate change. For a moment, back in 2021, it looked like investor activism was going to be a really productive lever for getting companies to invest in decarbonization. But as I'm going to outline, the outlook there is a lot murkier today. Our mission at CAS is basically to analyze how this system works and release data and tools to help debug it and drive it in a productive direction. Before coming on board to run CAS, I was an investor at Fidelity, where I covered small and mid-cap media stocks, and then looked after our book of investments in private consumer tech companies. So a few observations about the state of play to frame today's discussion. First, the recommendations of the Task Force on Climate-Related Financial Disclosures and their framing of climate issues in terms of risks and opportunities facing individual issuers are now widely accepted as table stakes among investors and public companies. Second, despite rapid progress on the adoption of the SASB standards for ESG reporting and the TCFD framework for reporting on climate issues, the number of shareholder proposals calling for companies to do more on climate continues to increase. Third, at the intersection of these two trends, a natural outcome is that as more and more companies adopt some kind of commitment on paper to net zero, more and more of the proposals from activists targeting public companies' climate strategies are aimed at companies that already have some kind of net zero goal or ambition. So implicitly, they're shifting from calls for additional metrics, disclosures, et cetera, into referenda on the specific strategies that companies are pursuing to deal with the energy transition. Fourth, in many cases, investors have been using shareholder proposals quite creatively to signal directionally their approval or disapproval of how management teams are approaching the climate crisis. While this can be productive, it can also sow confusion in the broader ecosystem about what specific policies asset management firms actually support and what their bright lines for voting against management teams actually are. Finally, our analysis of the annual meeting cycle year to date shows that investor support for these climate proposals is set to decline yet again, after declining last year. So to dimension this, over 70% of the companies in the S&P 500 by market cap now have some kind of company claimed net zero target. And over 80% have adopted the SASB or TCFD reporting frameworks for ESG and climate issues. This has been driven in part by the policies of big asset management firms, which have outlined their endorsement of the TCFD and SASB frameworks in official proxy voting guidelines that they make publicly available and that offer guidance on how they will weight ESG policies in their decisions to vote for or against specific proposals at issue at corporate annual meetings. Despite this progress, the number of shareholder proposals taking aim at corporate climate action has continued to increase. And this year's vintage of proposals will come out at about 65% above the average number of proposals we saw from 2019 to 2021. The number of proposals actually going to a vote has grown even faster, as it's been harder for activists and companies to reach negotiated settlements, and as the SEC has been less generous in granting no action relief into companies who seek to omit activist proposals from their proxy solicitations. Ultimately, what we're seeing now is that about half of the proposals calling for companies to set ambitious greenhouse gas emissions targets are aimed at companies that already have some sort of net zero target or commitment, according to Bloomberg data. That's a sea change from 2019, when almost no activist proposals calling for targets were aiming at companies that already had some sort of commitment, regardless of how high integrity it might be, to net zero. Furthermore, shareholder proposals have raised the bar. And over the last two cycles, nearly 80% of proposals calling for companies to set emissions targets have included some reference to scope 3 emissions or value chain emissions that come from the inputs that a company buys from its suppliers or the use of products that it sells on to its customers. Scope 3 emissions, in addition to various methodological issues around accounting for scope 3, which can be difficult for companies with a fragmented supplier or customer base, raises all sorts of questions around the systems level outcome of individual company level targets, and has been resisted quite intensely by companies and industries that have very material scope 3 emissions, most notably oil and gas. Something that we think is often misunderstood is that investors have been using shareholder proposals less as a literal endorsement of the text of the proposals and more as a directional signal to management teams about the state of their response to the climate crisis. You can see this by tracking BlackRock's votes on the proposals filed by the Dutch activist group Follow This, which have been essentially the same across target companies and over time, calling for scope 1, 2, and 3 emissions targets at oil and gas companies. In 2020, BlackRock said the Follow This proposals that made it to a vote were not in shareholders' best interests. In 2021, they changed their mind, stating in many cases they may accelerate the company's progress on climate risk management and/or oversight. Finally, in 2022, they once again voted down the nearly unchanged proposals. Apparently, they were once again not in shareholders' best interest. Last year, there was a lot of coverage of the year-on-year decline in investor support for climate proposals from activist groups. Our analysis shows that trend has continued as the passage rate and average support for climate proposals falls back below 2019 levels. And notably, this isn't just a function of higher quality or more moderate proposals reaching settlements. Our analysis shows that the net success rate of proposals, which we adjust to take into account withdrawals and omitted proposals, is also in decline. Finally, while it's true that many proposals in the last 2 years have been focused on cutting financed emissions at banks and insurance companies, which to date has been something of a non-starter for many investors, we think the really striking trend is that net success rates are falling across all proposal categories that we're tracking. In conclusion, we think that there are harder yards ahead for activists hoping to leverage asset managers' voting power to achieve climate goals. Emissions reporting, climate risk disclosures, and net zero commitments are now seen as table stakes for big public companies in the US. The battlefield has shifted. Now, activists have to convince investors that companies' existing climate targets are insufficient and that their strategies are misguided if they want to drum up shareholder votes against management. Today, this is a tall order, and something we're focused on at CAS is trying to build more consensus on these big open questions of emissions target setting. Because despite the efforts of groups like the Science-Based Targets Initiative, the truth is there is not yet a widely agreed upon standard for how companies should actually set targets. With that overview of the current state of shareholder action on climate out of the way, I'd like to shift gears and open up the conversation to our panelists, Madison Condon and Ben Braun. Madison, Ben, thanks for joining us today.
Thank you for having us.
So I wanted to pick on some quotes from some papers that both of you have written. Madison, you wrote a paper back in 2020 investigating whether asset manager support for companies voluntarily reducing their emissions was a sign that BlackRock and Co. were embracing a universal ownership perspective. More recently, Ben, you've asked, why have asset managers not used their control-based power for an aggressive push for decarbonization? So I'm curious, in light of everything that's happened over the past couple of years, what you guys think the asset management industry gets out of promoting decarbonization, and where its motives around the energy transition might align or misalign with the interests of the economy as a whole.
Such a good and hard question. Okay, so maybe let's break it down into two steps, because I have like a very specific question to ask Ben that I think maybe like gets at some of where we diverge in thinking about this. So right, I wrote this paper that was basically like, it seems like it's in the best long-term interest of the economy to stop climate change because we could all die, which would hurt the economy. So maybe that's an explanation, easy explanation for why asset managers have started in all these various ways, voting being one, changing like remuneration and how CEOs are paid is another. Maybe that's an explanation for why they're doing this. So there's been like many different attacks to this argument. I'm not the only one who's made this argument. This universal owner idea is also sort of an old idea. I just applied it to climate. So there's one category which says of sort of why this isn't happening, which is that it's not in the economy's best interest to have these oil and gas companies voluntarily reduce output. I think that's a thing that we can table maybe for like a later question. I think Ben, and maybe you can help clarify, I think your major objection is that actually it's more of, I think what we would call in corporate governance, like an agency cost problem, in that like where the people at BlackRock actually get their money from is like attracting new business, which is not really measured by like making their assets grow in total or not, because they don't really make percentages over assets managed. It's all sort of about marketing. Is that your argument? Maybe I want to let you take over and say more about it.
All right. Well, I can jump in here. I think that is one very important argument for me. Yes, that starting with the business model, I'm a political economist, so I come from the business model of asset managers as opposed to other even financial firms, or as opposed to mainly for me other types of shareholders that we've seen historically, which were, let's say, what we call asset owners today, institutional investors, such as institutional asset owners, such as pension funds, which of course today are still present, but at one remove, or one more remove, or households under the Burlean means, in the Burlean means world. And so, yeah, I have some very serious doubts about the alignment of various interests, even if, and that's a big if, we assume that these institutional and individual asset owners that are invested in diversified index funds, and therefore are also, in addition to being citizens of the earth, universal owners, want to act like universal owners. So maybe I'll leave it there and return to you. But then, yeah, another objection or concern is that, yeah, the function of asset management maybe doesn't allow these actors to promote the large-scale transformation of the economy, but that we need, but that's something for later in the discussion, I think.
Cool. I think I agree.
Yeah. Great. So that was easy.
Should we say more? I mean, about these mechanisms or like why they do and do not? I mean, we can maybe leave that for later.
Yeah, I mean, maybe something to pick up on, because Ben, you mentioned Burlean means. In one of your recent papers, you discuss what you call this sort of Burlean means Jensen-Meckling ontology, which is basically your shorthand for the established way for thinking about how financial sector institutions exert power over non-financial companies, right? And you sort of talk about that as the established paradigm within academic research on kind of shareholder power and influence in the United States. And I think one of your big contentions across your project is this idea that things have shifted, right? And the sort of structure of shareholding has changed a lot. And I think I would love it if you could sort of unpack for us what that Burlean means Jensen-Meckling ontology looks like, and sort of where you think that older model maybe falls apart when you try and talk about how public markets work today.
Okay, sure. I will try to do that very briefly. There's obviously a lot there. And I've received some justified pushback for mixing Burlean means on the one hand and Jensen and Meckling on the other in together. But basically what I mean by this notion of the Burlean means Jensen-Meckling ontology is the conventional wisdom that the United States and some other countries that we put in one group in comparative political economy, that the United States is a dispersed ownership society with weak shareholders in which these shareholders are nevertheless the ultimate stakeholders in the corporation. So dispersed ownership with weak shareholders, that's basically the Burlean means component. They were critical of that, of course, arguing against basically corporate power. And then the Jensen-Meckling assertion is that shareholders are the only serious candidates for long-term stakeholders in the corporation. And so that together has formed, in my outside reading, I'm not a corporate law person, but that has shaped how practitioners and theorists of corporate governance have been thinking about this. And the problem, in my view, is that none of this is the case anymore. Shareholdings in the US are no longer dispersed. The top three holding close to 25% in the average S&P 500 company. They are therefore no longer weak. And they are asset managers, not asset owners, and therefore do not have a very strong claim to being the ultimate stakeholders in the corporation. So this kind of falls apart, and we are in this peculiar situation where the ideology of corporate governance that this paradigm has helped bring into the world still exists. The institutions and the legal framework still exist that we usually refer to as the shareholder value regime or the shareholder primacy regime. Shareholders are still historically at peak power compared to other groups, notably, of course, labor. Organized labor has declined at the same time as shareholder rights and power have increased. But so we have that legal and, let's say, ideological framework are still intact and in place. But the shareholders, the Jensen and Meckling, in a way that were the legitimate material basis in the sense that they were real, that they assumed for their model, they are no longer, they still exist. These institutional capital pools still exist, but the actual shareholders controlling the votes are very different beasts.
I guess I would just add that, so it's really interesting the ways of what you would call shareholder primacy. Like there are long documented debates about the ways this like is and is not the law or reflected in law and culture. And like we could go on about that forever. It is surely taught, or up until very recently was taught at business schools, that like your job as a business person was to make the profits higher for the shareholders, and that your shareholders were the boss. And there's a bunch of legal decisions from like Delaware corporate law that we teach in corporate law that basically say that also, that like in certain situations, yada, yada. So you know, in the universal owner context, I write about this as sort of like, we mush together these ideas of shareholder primacy between like assuming that what shareholder wants is maximizing the share price and building an entire legal system around that. And the difference, or like doing what the shareholders want. And in law, this actually matters because the court cases are actually like not so clear. And sometimes it seems like it's actually doing what the shareholders want. And sometimes it seems like actually it's maximizing the share price. So that's one problem. So that's the Jensen and Meckling jump. This sort of like, oh, we're just going to assume that the only thing shareholders have in common is making this one individual company's price higher. And so what I'm doing in the universal owner argument is saying like, well, there's a few things wrong with that. One, the price could just be wrong because of climate change. And so I have this whole paper about why the price could be wrong. And the price could be wrong actually like because of this whole phenomenon itself, actually, like, and I think we'll get into this more, but I do think it's so strange that like there's so much of the capital markets in these huge passive funds that like the actual allocation of the assets is done through these like very strange metrics that at least in the climate world are like very divorced from the reality on the ground. Even if you're thinking about like pure financial risk, not even like emission of decarbonization, like we can talk more about this later, but like whether scope emissions is the appropriate metric to be weighting your portfolio is very unclear to me. And yet, because we've inserted like yet all these, like, not only is there this like step away from me, the retiree, to the institutional investor, to the asset manager, there's yet another step, which is like the asset manager is actually like licensing these lists of companies from these index providers, which are not regulated in any way with like a fiduciary duty or any kind of oversight to be like, are you doing your job correctly? Like, are these metrics that you're selling representative of the risk? So that just leads to, even within these institutions, you have like one group of people who's directed with voting and maybe who have like a sort of systemic view of the economy, or like might think about the long-term risks. And those are like not in any way the people usually making like capital allocation decisions, who are like licensing the index funds and maybe doing the marketing. And that is a very strange thing even within like where these markets are like flowing. So maybe I'll wrap up there. I guess I just will say, like, you know, Burley and Means, when they first identified this problem, which they call the separation of ownership from control, that's sort of like the Bible of corporate law. Like every corporate law paper cites that book. If you actually read it, it gets like very hippie at the end. It's sort of like the only way we could possibly do, like, handle this situation is if we like have some sort of like institutional manager that like manages corporations for like the best of everyone. And so there is this sort of window of opportunity where you're like, well, is that what institutional investors could be? Is that not what they're doing? It seems like they're doing that in a bad way. I'll stop there.
Yeah, no, that's super interesting, Madison. And you know, I just want to sort of double click on what you were talking about around universal ownership, because I mean, I don't know, looking at things not as a corporate law person, I mean, my kind of like intuition on this stuff is basically that it's kosher as an asset manager to say, look, I'm trying to sort of manage around the value of this whole portfolio, which is like a basket. It's like a basket of companies in the S&P 500, or it's like an actively managed but S&P 500 benched product, or something of that general species, right? And I think it makes total sense that you would say, look, I'm trying to optimize the value of this fund, not necessarily the value of every single company in the portfolio, right? And I don't want company A producing a huge negative externality that hurts company B and that leaves me net poorer as the owner of the index. You know, there are other funny scenarios like, I don't know, company A offering to acquire company B, and, you know, et cetera. But it strikes me that like another big kind of issue in the sort of chain of causality of using shareholder advocacy to achieve sort of positive social goals or to mitigate negative externalities that are being produced in the business as usual case, is that you then need to take that perspective and sort of hand the ball to a board and a management team that really do have a fiduciary duty to concentrated shareholders of the individual company. And I'm wondering if you could sort of like unpack that legal distinction, whether I'm sort of missing any of the subtleties, like how that sort of works, because that sort of seems to me to be where the universal ownership approach runs into some real execution challenges.
That is the real sticking point. So there's actually a really interesting case that's being brought in Delaware right now against Meta/Facebook by this group called the Shareholder Commons, which is run by Rick Alexander, who's sort of like a original universal owner guy. And the lawsuit is saying that Facebook violated its fiduciary duties to its diversified shareholders by, I don't forget exactly what the harm is, by like making Facebook like spread disinformation to the economy. It's that kind of claim. So really interesting in the sense that Rick Alexander like knows what he is doing. He's a very experienced corporate lawyer. He was one of the lawyers that helped bring one of the cases that to me literally solidified the shareholder primacy doctrine in law. So either way, it would maybe at least be clarifying. I think that's maybe part of the strategy, like what Delaware decides to say, because that question has not been answered, actually. Meaning, like, so have we constructed this system where
which seems like an important
where we like zombified companies where like
out.
actually the only thing they can do is maximize profit, even if everyone doesn't think so? Like, it would at least be like, because it's so amazing to me actually how much Delaware law gets away without a lot of scrutiny for how much it shapes like the very fabric of the economy and like the way companies work and govern us. So that'd be interesting. I don't know what's going to happen.
Can I just add one thing to this? I think I agree. It will be extremely interesting to see what comes from this case. And I just would add here that these attempts to use shareholder voice, right, for, let's say, issues of societal concern has a history. And basically, shareholder voice became a thing in the 1970s. I've been looking into this a little bit and am now more with basically Ralph Nader and shareholder activism on social and environmental issues, although not climate issues, of course. And the interesting thing is, Rick Alexander is not an asset manager, and Ralph Nader was not an asset manager. And when they tried that, and it started with GM, making GM socially responsible in 1970. They got it onto the ballot box, onto the proxy ballot, but then lost the vote. But this engendered many follow-up actions of a similar kind, and there was a huge backlash. And I have not figured out how, I have not traced that to the present day. Would be a very worthwhile endeavor, but I have traced it for the 1970s and early 1980s. And there was basically a huge backlash against this, the law and economics movement, which we credit for basically paving the way for shareholder value ideology, was on the side of corporate interests in this fight, which is extremely interesting. And I would say the outcome of this was to consolidate an understanding of shareholder voice as limited to the maximization of profits. That was essentially the legal, as I understood it, struggle, and then the defenders, let's say, of at the time managerial autonomy won. And it's interesting that they had on their side the academics from the law and economics movement that, Jensen and Meckling were essentially off that camp. But the same group, that intellectual movement, intellectual/conservative movement that was credited with helping bring about the shareholder value regime, in that crucial conflict was on the side of corporate interest and on the side of preventing societal concerns from entering basically corporate governance in a way that's sanctioned by corporate law. Just a cautionary tale, I would say.
Right. No, that's super interesting. And, you know, I mean, something that I think you both will probably have some interesting thoughts on is this tension between, right, between a sort of like expanded sense of shareholder primacy in which shareholders call the shots, but shareholders' interests are much more aligned with, let's say, the overall economy than with an individual sector or an individual company. And so the shareholders are, you know, basically looking over management's shoulder, but in the interest of, let's say, a broadly diversified investor who wants negative externalities to be minimized, versus another conception of sort of how you justify corporate social responsibility in a broader sense, which is management has a lot of discretion. Management has discretion to look after long-term versus short-term value. And looking after long-term value means, you know, looking after, let's say, the highly unionized workforce or the communities that a company operates in, or not, you know, cutting lots of corners that could lead to environmental damage that could create lots of expensive litigation, right? This idea that management has a lot of cover to sort of do stakeholder focused business, and under the sort of sigil of this is long term and not short term. And so it seems to me that there's a tension between like the traditional vehicle of justifying like a stakeholder approach to running your business, which is these shareholders just want me to sell to private equity, or, you know, whatever, want me to sort of run the business to, you know, deliver a great 12 to 18 month total return. And I'm actually looking after like next 20 or 30, I have a generational time horizon, right? But, you know, that sort of tension. But now we sort of expect shareholders to be the sort of, to sort of carry water for ESG or for like a broader and more inclusive understanding of what companies are doing, which to me seems like, that seems like a really deep tension. I'm curious how you guys think about that in your work, and sort of where you think, sort of how you think that tension is being dealt with kind of in the research in your fields.
Yeah, I mean, none of these things happened in isolation, right? So like these shifts in the 70s and the 80s in corporate law were happening like in light of globalization and in light of offshoring and in light of like labor deteriorating anyway. So one thing that I think is so interesting, I learned from you, Ben, I think from your scholarship or just talking to you, is to think more about like, why do asset managers have all this money? Like, where did this money come from? And what decisions led to them having all this money? And there, I think it's pretty different in Europe and the US, and that's the thing I'm trying to think through more. So, you know, there were a series of political decisions that means that some amount of money gets taken out of my paycheck every year, and it gets put in a fund that is, the institution is chosen by my employer, but I get like some amount of choice over where that money gets placed. So Bennett makes the point, I don't know where you make this point, I think at dinner once or something, like that all of that money could just be somewhere else. Like we could have like a public retirement situation, we could have normal workplace pension funds in which like the political economy of what happens to that money would just be different. Like the employer would have some sort of pressure about how to manage it maybe, or like it would just be in the government. There would just be a different way of handling retirement. So that's one thing to think of. And in the rhetoric of leading up to all those decisions, there was all this like shareholder democracy stuff. Like we need to give citizens a voice, like we're going to have everybody be so empowered. And so now it's sort of funny that when asset managers are reacting maybe to like consumer pressure or like marketing pressure, the like same party, the Republican Party that like thought that this would be like a mechanism of shareholder democracy now is like, stop doing that. Like, no, actually, we don't. Actually, this is just for like maximizing share price. This isn't about like voice or choice at all. I don't know where I'm going with that. That's one thing I think about. That, yeah.
Yeah, I can totally take it up from there, and add that in my reading of the situation, and I completely agree with what you just said, Madison, it's we're at a point where basically asset managers are so large that they have taken on to their balance sheet not just all of our retirement assets, and pretty much every household except for the bottom 50%, of course, never forget that, are exposed to them. They have also taken on basically all of our political and social conflicts. And so the idea that corporate governance would just be about corporate governance has also gone out of the window. And this the fiction that you could sort of sanitize corporate governance, which is another reading of, the shareholder revolution, is a sanitized interpretation of corporate governance, when really people like Bernie and Means were still fully aware that this is high politics, and this is basically in a corporate society, this is where the main conflicts in a society play out. And this is what we're seeing the beginnings of, I would say, with asset managers now. They've been forced to realize in the US that there are two parts of the country, and two political parties and two types of pension funds. So they want to maximize assets under management. That means doing, let's say, green corporate governance in a way that's green enough for, simplified, the 25 democratic states with pension funds, and dirty enough for the fossil fuel obsessed 25 Republican states with pension funds, simply speaking. And they have to do that in a way where they do not invite excessive costly regulation, because in addition to assets under management, the second main factor in my reading of the asset manager business model is cost, and that is regulation determined. And there's a lot of very bad stuff regulators could do to the big asset managers, in theory, and those regulators could be instructed by a Democratic majority or by a Republican majority, again. And they're trying to walk a very tight, a very narrow, basically, path that's increasingly untenable from a, I would say, climate perspective. And the reason is basically that, well, if under asset manager capitalism, that's where social conflicts play out. Everything's on their balance sheet, even though they are only managing other people's money.
Yeah, no, that's all very astute, Ben. I mean, to your point about minimizing cost, I mean, I think one of the big challenges here is that, the way that this ecosystem is going, it really seems that there are just going to be more and more climate proposals, and vetting the proposals is going to be less and less about sort of adhering to a kind of box checking standard for, basically what you should include on this big annual report that you're going to put out and put your emissions on, and a bunch of other data and sort of a qualitative risk assessment. And suddenly it's really going to come down to, well, is your strategy aligned with this like pretty prescriptive scenario that is maybe like, like a good aspirational way to think about the energy transition, but is not sort of near term the path that we're on. And so it's sort of asking passive managers who control a ton of votes to be kind of thoughtful, active managers, and to sort of like have detailed industry research, which the whole point of Vanguard and why they can charge like 8 or 9 bips is that they don't have like a guy who's been there for 20 years and knows all the oil and gas CEOs and and goes around and meets with them like every quarter, right? Like that, the whole model is we don't do that. And suddenly you either sort of adopt a more kind of rules-based approach to these proposals, or you suddenly need to have people who do that, which is not your model. And then I think for active managers, it's really hard to get over the hump and sort of identify, well, is this material? Is this sort of like something we can defend from an investor perspective? And so it's like, for the active guys, it's, does this make sense from an investor-centric perspective? And then for the passive guys, it's like, you know, like we don't have, like, the whole thing is we don't have like a deep bench of like internal research on these industries. And suddenly, you know, maybe, you know, we need to, or we can default to a kind of more programmatic approach, which I think what we're seeing in the case of Vanguard is often that approach is beyond asking for certain specific disclosures that we all agree are good and that every company should make. We're not going to push companies harder, and they know their industries better than us. And we're not going to sort of dictate to them like what percentage of your CapEx should be in you know, renewable energy or in kind of new business lines around hydrogen or carbon capture and storage or what have you. The various kind of low carbon opportunities that people like ExxonMobil talk about. That's more of a comment, I guess. Sorry, I know that I'm wearing the question asking hat and not the comment making hat. So I apologize.
I have a question that like follows from that, or like, it just is strange to me that it's acceptable for the CEO of Vanguard, was it Tim Buckley or something, to get up there and be like, I'm the world's largest asset manager. I have no idea, like, if these companies, I like don't understand the business plans of these companies or like their sectoral position or like how they're going to do in the future, like at all. And it's like everyone's okay with that because of this whole like efficient markets thing. But increasingly, it's like, you know, it's not even clear to me that this is about stewardship or necessarily has to be about stewardship. Like I've been in conferences where it's clear that asset people in the private sector are having trouble like pricing and responding to the IRA, mostly because like, one, they've been thinking about climate policy through carbon pricing and like scope emissions for too long, which does not translate into
absolutely
tech specific. It's so funny listening to them be like, we don't know how to do this, like we don't know how to price the IRA, when it's like, isn't that your literal entire job? Like not even separate from like stewardship or ESG or activism, like pricing regulations and like responding to technological change seems to be like why we have finance or why we have analysts. So that's one really funny breakdown. And two, like, I'm writing about this, but it's actually quite hard from a legal perspective, and I think increasingly from an analyst perspective, to like say whether you're doing something like for a pro-climate stewardship reason or just because you're trying to like go with the trend, because something has shifted. And so I do make jokes about like the IPCC being like getting tackled for antitrust for like releasing these scenarios. Like it's not really a secret where we need to go. So if everyone's trying to like use the same scenarios and like see if all the scenarios fit together, it's chaos at the moment, but it's not, maybe I'm going to pass it off to Ben. It does seem like there's some like chaotic coordinated central planning happening between like the asset managers and all the different institutions that support them as we all like fight over like what the exact version of the future will be. Ben?
Well, that was a very generous pass on. Thank you. I couldn't agree more regarding the absurdity of like let's say outsourcing planning to individual analysts that are highly specialized and in competition with each other, which works when the goal is to maximize profits at the individual company level. That form of market-based coordination that we're so used to in our thinking about the economy works with the negative externalities if the only ones who are able to do that with any consequences in the real world are shareholders, but that's a different question. But it doesn't necessarily work at all when the goal is to get somewhere where we know what it is, which is reducing greenhouse gas emission as fast as possible. The only thing I would say is that we don't actually, the reason Buckley says this is that he is, of course, right. And it's not surprising that he doesn't know, given that, if we put all the corporate governance people from the big three asset managers, say, in a conference room, then that conference room is barely half filled, depending on the size. And then we could put in, all people working in governments around the world on climate. And there are many, many more people and working on the same problem. And it's a very difficult planning problem. And we're so used to thinking in terms of market-based coordination as being superior to state-led coordination in the economic sphere that we easily, I think, forget that with climate mitigation and adaptation, it's really just the same logic does not apply. And I think that's quite obvious and demands urgent action. And whatever we discuss on a panel like this, or when we discuss the role of shareholders generally and asset managers in particular, we need to be quite aware of this paradigm shift that's, in my view, inherent in the nature of the problem.
Yeah. No, I think that's all really astute, Ben. I mean, something it's making me think about is, on the one hand, this also touches on a trend that Madison was talking about, which is like this long-term trend, particularly in the US, from DB pension plans where companies had balance sheet risk to DC plans where the company doesn't have balance sheet risk and neither does the asset manager. The plan beneficiary, in a sense, carries the balance sheet risk, which is that in some ways, like, we've created this really like anti-fragile financial system where even the like bank runs of earlier this year don't really shake the money center banks and don't really have the same kind of contagion effects that we saw in the GFC. And so the problem is there's too much stability and it creates moral hazard, because if I'm an asset, like if I have a world where there are three, toy model, where I have three asset managers who collect 10, 15, 20 bips on ownership stakes in all the outstanding shares of all the public companies in the world. And, all those companies are great businesses. They print 40, 50, 60% operating margins. 60 is a little punchy. It's more like 40, right? And, they have like clean, unlevered balance sheets and the investments are not on their balance sheets, right? And so it's like, whether like, there are lots of problems with like the Nordhaus-Dice approach to thinking about climate, right? But using that as an example, like if the impact of global warming is like, okay, we shave a point off the world economy, that's not an existential threat to you. I mean, your bonuses are not going to be as good, maybe, right? Or you have like P&L pressure, but it's not an existential risk. Conversely, imagine a world where like all those shares are held by banks that have like a thin sliver of equity sitting on top of like an enormous pile of leverage. In that case, a 1% decline in the value of your assets is a real problem. It's a huge problem, and it's urgent. And so, in some ways, the lack of fragility in like the contemporary post-GFC world is I think a moral hazard for dealing with climate in an aggressive way. I will pause there.
The lack of skin in the game is I would say a huge part of my skepticism regarding the business model of asset managers is such that they don't even have, not even banks have, traditional banking has been highly prone to, of course, like huge busts, and then the state comes in and often bails them out. That's a different story. But banking is defined by having skin in the game in a way that asset managers do not. And in a way, one could argue that the best thing a CEO of a large asset manager could do is to retain the relative position of that asset manager vis-a-vis their peers. in the competition with their peers, and that is consistent with any path in a way to towards decarbonization, and that's a scary thought experiment in my view. That ultimately, I think that other forces will shape the path, and it's most important to empower, let's say, the Rick Alexanders and so on, to further shape or to further accelerate the shift that you mentioned, Madison, that I no doubt has taken place, in order to make it so that it becomes more and more, let's say, necessary from a business model perspective for these asset managers in order to keep their money, in order to prevent the institutional asset owners from withdrawing their money and taking it elsewhere, as we're currently seeing from the red states in the US, from the wrong side, from a climate perspective, and B, to incentivize them to do the right thing in order to stave off costly regulation. So yeah, these things will be very important, which is obvious, but I think once we think about the fact that it is impossible for these asset managers to know which type of corporate behavior at the individual corporation level is, let's say, Paris aligned or not, without knowing the precise, not the precise, but the rough plan for getting there in terms of the structure of the economy. Like, are we trying to build more EVs, or are we trying to massively build out public transportation in the United States, for example? Depending on your answer to the question, individual corporate strategies in these sectors, are either aligned or not aligned. But this is not a decision even the most powerful asset manager can take. This is a political decision, and the lack of, let's say, knowledge that Buckley, for example, professes to is not just because they don't have the capacity to decide, but in my view is structural also, because individual company plans make sense or don't make sense, not just based on their emissions next 5 years or 10 years even, but also based on, well, if they are contributing to the material basis of a decarbonized economy in 20, 30 years or not.
Yeah, and I think that that's where it starts to get really complicated, meaning, like, one, just from a basic accounting problem, like, you have these companies making net zero goals, net zero pledges, which would seem to like substantially change at least some of their business model, or at least their like present day capital allocation. And that is not reflected in like the accounting that they release at present to their shareholders, which seems like a present day fraud issue that needs to be resolved. But then so Ben, I would love, and Nolan, I would love to hear your thoughts. Like, the EU has gone so full speed ahead on trying to do taxonomy, do a taxonomy of the decarbonized economy, like what would be a green aligned or not green aligned investment. And it seems to me like they're going to do this through like a panel of experts that is like semi-technocratic, democratic, but like, I don't really know. But okay, one, this seems like a very complicated endeavor, right? They're going to have like a big panel of like what the cement industry would look like, and then what like a green equity in the cement industry would look like. So I guess I'm wondering, like, how would we do this differently? Like, this seems not, what do we do? Benjamin and Nolan. Do you have thoughts?
Yeah, no, I mean, it's super interesting. So I have a couple thoughts. One is like, something that I always find frustrating is how we talk about stranded asset risk. I think basically, we don't know what the future will bring. We don't know how many degrees of warming we're headed towards. We don't know what, to both of your points, what the actual like mix of energy technologies is going to look like at that end state or at any intermediate point along the way. And what that looks like is going to be determined by market forces, but also by policy set by countries all over the world, some of which sort of believe themselves now to be in kind of open, almost Cold War-esque competition with each other around all sorts of things like security, but also around coming up with some sort of green industrial strategy. So that's really hard. And I don't think like stranded asset risk should be anathema to us. I think stranded asset risk is people should be taking on stranded asset risk and compensated for it with like an attractive rate of return that potentially attracts enough capital to, let's say, take the over on natural gas demand in 2030 or 2035 or 2040, right? And if that doesn't pan out and we decarbonize faster than you're underwriting when you make that bet, then you'll lose out, but you take on that risk. And the upshot is either you take on a bunch of stranded asset risk that's internalized on your balance sheet and you swallow that loss, which you've hopefully sort of planned for with like careful portfolio management decisions, or we do actually need a lot of natural gas or whatever at the point of consumption. And if we have it, right, and we have energy security. And it's not that like stranded asset risk is not unique to the fossil fuel value chain. There's going to be a ton of stranded asset risk in like new energy technologies that may not pan out. We don't know to what extent like hydrogen versus electrification will like make up like what exact percentage of like end demand in hard to decarbonize sectors or in transportation, right? And so like there is stranded asset risk in like I don't know, a blue hydrogen project that might produce a lot of like dirty fossil fuel derived hydrogen that there might not be demand for in 2040. There's stranded asset risk is like inherent to all like long cycle investments that rely on really probabilistic bets on the future. And so I don't know exactly where I'm going with this, but that to me seems important. And it seems like an important kind of pillar to be thinking about as we're thinking about the wide range of scenario outcomes. Second, I mean, something that we're talking a lot about is shifting from emissions accounting to a kind of like more activity-based or technology-centric way of thinking about climate impact and climate risk. I mean, I think that's really healthy. I want to give Ben a chance to answer Madison's question, but after that, Madison, I kind of want to circle back to that and get your take on it because you've written a lot about Scope 3 and thought a lot about scope accounting, and I'm kind of curious how you would think about like the accounting challenge of maybe not mothballing all this work we've done on coming up with standards for emissions accounting over the past 20 years because it serves a purpose, but thinking about like in a candid way, how fit for purpose is it for actually kind of investing behind the energy transition and the like value chains that are going to win out in a decarbonized economy. But Ben, I'm going to table that and pass the talking stick to you on Madison's question.
I don't have a strong opinion. I'm not enough of an expert. I'll just say that bluntly on EU taxonomy efforts. You'll have to do another one and invite some friends. On that, just to the broader point, I think that is an effort that goes in this direction of, but not far enough in my view towards recognizing that the ultimate constraints in this race against a catastrophic global warming is and will be increasingly material constraints, not money and financing. And we can't afford basically wasteful innovation races in the way that we're used to. And that's a very fundamental problem because it means that decisions have to be taken on technologies, and shareholders cannot take these positions. And so, of course, the usage of hydrogen in the transition will depend on technological innovation. So the example you brought up, Nolan, there yes, we need all the research, R&D we can get, and so on. But the example I brought up, EVs versus public transportation, there is and increasingly will be material constraints. And so we have these two problems. And when we talk about, let's say, who's in the driver's seat and how much can shareholders do and not do, we need, in my view, to distinguish between increasingly these two different problems.
I think when you add physical risk into that, which I just wrapped up a really big paper on, and I just think, frankly, like no one in the private sector, maybe insurers, like really understands what is about to happen in the next 2 decades. You know, I watch these like growth versus degrowth fights, which are pretty meta, and to me, I'm like, the mission should be to try to degrow the least. Like we should, and I really like the way Ben sort of put it, meaning like, we don't have sort of room for some of like creative destruction style, like Schumpeter style, like we're going to be in triage mode. It seems to me, based on like the water that we're running out of, and like triage mode requires planning. Yeah, that's what I think. Hopefully I'm wrong. That'd be cool. Yeah.
Right. No, I think that's all very well said, guys. And basically, I think there's a really nice distinction there between elements of the energy transition where like the potential constraint is capital, in which case you can afford to throw spaghetti against the wall, and where the like scarce constraint is like, yeah, a physical resource that we have a finite amount of, which is obviously the case with like, you know, water and a bunch of other stuff in a lot of regions of the world, and is also the case with critical minerals. And so I think that's like a really useful mental model to kind of have in your pocket when you're kind of thinking about these claims across sectors, because in some cases, the funding is the constraint, and you can sort of afford to let people go buck wild and like raise some money and try something. And there are other areas where like certainly policy from the public sector needs to play a much stronger role in kind of basically sort of closing off certain pathways on the decision tree. I think that's all very well said. Madison, I want to sort of circle back to this question on deck about scope accounting. You know, maybe if you could just sort of unpack some of the key findings in your paper, what is scope 3 actually good for, and kind of talk about some of the like conceptual challenges there. I think that might be a good sort of way to kind of bracket that conversation about whether we should be doing whether we should be focusing, I should say, on emissions accounting at the company level, or on like a more expansive understanding of what transition risk looks like.
Yeah, I mean, so there's a lot of nitty gritty points, and there's some broader points. A really good paper is by Nicola Ranger and some co-authors, and Jimmy Gia, and I forget the third co-author, which really is a very good scientific technical paper of like why scope 3 in many ways is a completely nonsensical measure for the ways that people are like trying to do it, meaning like the sources of scope 3 data are internally inconsistent, meaning they're measuring different things. Like some scope 3 data comes to a company and it measures cradle to grave, some measures cradle to gate, some measures use over the product's life, some measures use over that year, and then it's all aggregated by like the person who's appointed to do this at the company. And sometimes there's no way to scale them all together. So it's like sort of chaos. The GHG protocol, which is like the standard setter behind scope accounting, is very explicit that scope 3 is not supposed to be used to compare companies against one another. It's supposed to be like an internally consistent methodology that a company makes choices about, that it does every year to see if its own emissions go down over time. That is like a good and acceptable use of scope 3 accounting. It should not be used to compare companies against one another, basically because of these inherent methodological choices that like you can't really get around. But that's what it's being used for, right? Like anytime you use scope 3 as like a weighting metric, which even I think the European Central Bank is doing some version of, you're comparing companies against one another. And like, it's just a snapshot of a year. It doesn't represent historical emissions, which is probably a big source of risk, I think, for fossil fuel companies, like as litigation against them mounts. And it starts to be like a very wonky proxy for future emissions, meaning like your emissions today don't really like two different steel companies could have the same emissions today and tomorrow and the next year, but this one has been like innovating in green steel the whole time, and like 5 years from now, voila, like has no emissions. Using present day emissions to weight these companies' transition risks like makes no sense. So I think this is where you start to get really down into like active versus passive, meaning like how much can you metricize the transition? And I think that's complicated. I think that some of why we're turning to the financial sector is because of like the inherent transboundaryness of these companies. Like if you can get Apple and Amazon to change things, you're changing like a huge part of an economy that knows no jurisdictional limits, which I think is one of the like appeals of doing it this way, but also maybe like one of the downfalls, which, as Ben mentioned, has like historical precedent.
Yeah, no, that all makes a ton of sense, Madison.
I'll just say one thing is that the person whose work I think is really good on this is Irina Monasterello and her co-authors, Stefano Madison, who really think they call it climate policy relevant sectors, meaning like literally what is the capital allocation of your company now? What would it need to be? Are you doing this? Like, this is the way we're going to code capital assets, rather than these sort of like corporate equity level. Like, it doesn't really make any sense to say whether a company the size of Amazon is green or not green. Like, that's a ridiculous, you can't up or down that question.
Right. No, I think that makes a ton of sense. And this like interesting sort of like, what is the like boundary of what the public markets know, like what the public markets know? I mean, I think it's like a really interesting question. Like the lack of standardization of data below the sort of consolidated company level, I think is like whether we're talking about physical risk or transition risk,
totally.
I think is a huge challenge for practitioners. Just because like spatial granularity and also like standardized segment granularity, I mean, these are just like really hard to reconstruct if you're just going off of 10Ks.
Yep. And it makes the whole thing sort of funny, where it's like, yes, obviously it matters like where the mines are when you're trying to assess your like mining company's exposure to climate risk. And yet even that basic information, you actually have to do a bunch of like, you have to hire some satellite scanner people. I mean, now it's public, but increasingly it's amazing how much very relevant stuff about the future survivability of a company is not at all something that an investor could easily get without having to pay a bunch of money to a huge database.
Yeah, no, totally agree. Which nicely tees up your paper, Madison, which everyone should read, The Business of Physical Risk. So let's transition to an open Q&A from the audience. I think we're going to get written questions through the webinar interface. Let me read some of them here. One, which I think is an important question, the one that I feel ill-equipped to answer, and so we'll punt to Ben and Madison, maybe unfairly, is, based on all this conversation, what do you think climate activists can do in the shareholder space to maximize impact? Which I think is like a really important kind of, I guess, it's a really important concern to bring into this conversation, right? I very much look at things through an investor lens, and we've been kind of bridging an investor perspective and a corporate law perspective and an economics perspective. But, you know, I don't know, are there takeaways for a sort of climate activist or a climate activist group that flow out of this conversation?
I think that we should think more of a strategy about where this money comes from, actually. And like, I do think that there's a level of like labor organizing that could happen. I would love Ben's thoughts on this. I haven't talked to David Weber, meaning like make your employer, meaning if we're not going to abandon this at all, it would be cool to work towards something where there like was actually a mechanism such that your money was not invested in a bad company. I don't know, maybe that's completely a pipe dream because they're all bad and that's like too deep, or at least that you could like require that your money be put in a fund, that the votes would always be voted for the climate thing. That seems like a useful thing that we could actually operationalize in like not that long. It requires much more scrutiny on also like the index providers. I think those are the two things. Like more organizing at the demand level for these products, and like 2, scrutinizing the like S&Ps and the MSCIs for like what they label green, and doing much more rigorous, like, actually, this is what it means to decarbonize. Those are my 2 ideas. Ben, you might want to just destroy the whole thing.
No, not at all. I just add a third one in sticking to my guns as a political scientist by training, would say that climate activists should continue what they do, lobbying basically in what we're talking about, financial firms, index providers, and so on. But they should also, in more than currently, is at least the ones that are thinking about finance and corporations, lobby the government, their governments. And one place to lobby, and I'm saying this because Madison brought it up, would be to lobby pension policy makers and get them to understand. And in my reading of this world, there is zero understanding of this, that pension policy today is, if you have a funded pension system, which many countries do, including, of course, the US, which accounts for 2/3 of the world's retirement assets. So it's first and foremost about the US, but then also about other countries such as the UK, Netherlands, and so on. If you have a funded pension system, pension policy and pension fund regulation is climate policy. Because you can regulate whatever you want. If we're at 3 degrees by the end of the century, then your pension funds are going to be completely useless, and you're not going to have a nice old age life. And that if that was understood, then policymakers, legislators could free pension fund fiduciaries from the duties that they are still currently under, and say, allow them to basically do what in some utopian visions they could already do, but in practice never do, which is to fund the green transition. And the state would have to be a big change. We would be halfway to a pay-as-you-go system if we do what I'm suggesting, which is use that money to fund the green transition. And there is, despite what I said before, we know that there is a huge investment gap that needs to be filled. That could be one source, but the state would then have to say, and whatever shortfall there is for the intermittent generations retiring, we'll fill that gap. So we'd be halfway towards a pay-as-you-go system. And of course, in my book, going all the way towards a pay-as-you-go system is not a problem at all, would be great. But halfway, with this logic behind it, would be a big thing. And climate activists, in my view, that would be a good use to go to this, let's say, unexpected corner of the legislative world.
Thanks, guys. Great answers. And I have to say, I don't think we'll be able to make it to all of the questions, but I just want to give my compliments to our lovely audience for asking so many sharp and probing questions on the heels of this discussion. I mean, a lot of these are really fun, and I'm sad we won't be able to get to all of them. Madison, I have one for you from Jason Disterhoff. I can't tell if there's a certain range, I'm quoting here, I can't tell if there's a certain range of climate impacts that's an assumption in the discussion. For example, say we're headed toward a 2.5 degree world, and 2.5 degree impacts turn out to be what we used to think 3.5 to 4 degrees would look like. And economically, that creates a broad climate depression, far worse than the Great Depression, would say a 25% hit to global GDP. Does that change any thoughts about asset managers' role and responsibilities in the transition?
I mean, I think I'm still shocked by the dissonance that happens between like the basic Washington Post article that summarizes the IPCC's findings and like the way actually recognized climate economists and people who invest in the climate space like speak about the future or like talk about climate change in general. So yeah, I first mentioned that there had been a bunch of critiques of the universal owner argument, and like one of them was this sort of like maybe the impacts won't be that bad. I think the impacts will be very bad. I think you have to factor in risk aversion and uncertainty and all this stuff, but like, yeah, I don't understand the calculus. I mean, if your question is like, look, I was going to add this. I think that when Tim Buckley at Vanguard says that it's like not his job to do this stuff, and yet turns around and like sells me a target date fund of 2050 or 2055, like that's fiduciarily wrong. Like I understand the ways the economy like will be impacted by climate change. And yet there's still this complete dissonance of people like not understanding that like the economy will be impacted. Definitely. Yeah. I don't have a good answer to that. Yeah.
Yeah. I think I would echo that, Madison. Here's a question from Ken Pucker. Asset managers are now promoting impact funds. Do you see any way apart from engagement for secondary market investments to deliver impact? I mean, my very short answer, given the conditional apart from engagement, my very short answer would be yes, but not much. But I'm curious if you guys would push back on that, or if there's any detail that you think is important to add there.
I guess the question is about active trading then.
And I think it gets to something you've written about, Ben, which is basically this idea that the corporate sector is not really a net. It's not really a net issuer of equity, and doesn't necessarily depend on equity markets to fund ongoing operations. And sort of where does that leave strategies for doing sustainable investing in like largely secondary markets? But I'm curious if you have thoughts on that.
Not fully worked out, but I think the answer would be not at the margin for big blue chip companies, but of course for specific sectors such as really the fossil fuel sector, it can have an impact. I would say divestment at some point will probably become real for some sectors and for some companies, and then this by definition has an impact. Then we are asking the question immediately: what role will private equity be allowed to play there? Which already, of course, if assets are profitable, highly profitable, even for a relatively short period of time, and big mainstream asset managers divest, but it's still profitable to hold these assets for the next 5 years, then of course there may be a case for what you brought up earlier, Nolan, like to phase out these assets faster via public ownership or other forms of decommissioning.
So as we kind of head into the home stretch here, guys, I have one sort of like closing question for both of you, which is, I'm just curious, not necessarily in light of this discussion, though. I mean, if this discussion has sort of sparked lots of interesting insight, by all means. But I'm curious, sort of, when you guys look at the state of the art in your respective fields on these questions, and you sort of think about what's going on in that literature and boiling it down for a broader audience, what do you think the biggest questions or debates are, and sort of what do you think the biggest like kind of unanswered or like underreported on discussions in in the political science world, in the legal scholarship world, and kind of how would you distill that for a savvy but less in the weeds audience that maybe isn't going to all the conferences and participating in all the seminars that you guys are?
Okay, Madison is telling me I should go first on this one. It's a very big question. I already went a little bit in the direction of what I would say to this earlier when I talked about the nature of this coordination problem. And maybe just, so I think this is where we really need to know a lot more and don't currently at a general public discourse, nor at the policymaker, nor at the investor shareholder level understand how that changes the game, is that we're used to market coordination, but market coordination is failing. And so we need planning, and the only agency that can do large-scale macro-level planning is the state. And if I would be interested in, I haven't done this, but I would be interested in research that asks asset managers and the people we've been talking about today, analysts and so on, would you, analyst, not CEO, would you be happy about more public planning that tells you which activities that you're looking at are actually going to be contributing to decarbonization and which are not? That I would find interesting. More generally, I think that we know how to do industrial policy because industrial policy has been done both in Western and countries and in Asian, East Asian countries, but it has been done in a world that was already globalized, but it was a world that was dominated financially by banks. And we don't know how to do industrial policy really in a world dominated by institutional capital pools, and where asset managers are the dominant actors and where they represent first and foremost pension money. So the whole problem of asset devaluation and how that will ripple through pension systems and so on, in my view, really makes this planning problem very different, or let's say makes it so that what we know about the developmental state and industrial policy 50 years ago, not one-to-one translatable. And so that's a big thing to tackle.
Cool, good answer. My field asks less interesting questions. My field is still like obsessed with this agency problem and different versions of that. And there, it could be an interesting question. There's all these interesting questions about, should we empower retail investors, or like, should we do pass-through voting? Like, should BlackRock simply like ask people what they want? And none of them are that satisfying, because it's a little bit like, we invented this entire asset manager system so that people like could not have to do this themselves. And so, I don't know. I want there to be more meta critique in my field in general about like, how did we get here and why? Because like often the scholarship begins with like, we assume that this is the system that is best for allocating resources. Political science is like more critical. I would say that in the US, law and economics had like an extremely pervasive influence on the way we think about corporate and private law. And there's been like not enough thinking of the ways corporate law like evolved alongside antitrust and evolved along like all these different ways we think about corporations in the political system. And hopefully we're like heading that way.
Great answers, guys. This has been incredibly fun. And I really appreciate you both taking some time out of your days to chat with us and answer all my questions. And I hope everyone on the call has enjoyed it too. I'm sorry we couldn't get to every question, but you can always shoot me an email. I'm easy to find. And so are Ben and Madison, though I want to protect your inboxes. I'm telling everyone to email me. And
only the most committed listeners are still here, so I feel confident.
Right.
Thanks, everyone. This has been great.
Thanks, guys. Cheers, and enjoy the rest of your day, everybody.
Thank you. Bye-bye.